Director and Head of India Research with Citi Research, Samiran Chakraborty, Managing Director and Chief Economist with Citi. They both join us, and I've seen, these are two friends of mine, and I've just seen them grow old and designations keep on changing, but one thing never changes, which is the whole vigor, approach and passion with they track markets and economy. So nice to have both of you back on ET Now. Thank you for joining us. Samiran bhai, I'll start with you, and let's start for a change with a smile, because on the macro front everything is looking good.
Yeah, I mean, a lot of tailwinds India is getting. To start with, there is a huge boost from lower oil prices. India is likely to be one of the first countries to strike a deal with US on the tariff front. Also, we have already done a trade deal with UK, which could be the template for it. On top of it, the policy is extremely supportive, particularly monetary policy. We've already seen significant rate cuts and liquidity infusion. Going ahead, we could get even more. And to some extent, in a very uncertain global world, India could be a relative beneficiary. And even from that perspective, we could see capital finding its way into India. And last but not the least, currency pressures not being there definitely helps with this kind of environment of dollar weakness. Clearly, policymakers will have one less headache to worry about. So all these things are positive, but we have to do our own things as well. We have to keep on doing the kind of reforms that is needed to attract this capital into the country and boost our manufacturing prowess. So that's the part where more work probably needs to be done still.
Surinder, if I take the clock back before we move it forward, when Indian markets were in a disarray, as a house you came up with a report, and it was quite a constructive report which talked about a year-end target of about 24,000 plus. We've reached there, and we've reached there because of liquidity, we've reached there because of macros, we've reached there perhaps because of earnings recovery also. Where are we headed next now, given that your price targets for the full year are already there on the ticker?
Sure. So to answer that, let me kind of take a step back first. In February, we turned overweight on India in our EM strategy. And it was driven by a combination of things. We had seen a lot of action by the central bank. We had seen the tax slab change being announced by the government. The valuations had corrected a fair bit at that point of time, both in absolute terms as well as relative terms. So I think all of those things had happened. And to that extent, valuations were starting to look more attractive. So that is where we had turned overweight, and we had index target, I think it was around 25,000 at that point of time, which subsequently the current index target we have, Nifty target we have for December is 26,000, which as of today is around 7% upside from here. So where we sit today, I would say that there is still some upside. And again, it kind of starts with the point which Samiran was making on the macro looking pretty decent. So that's the first point. Macro is still decent. Like earnings, I think obviously FY25 was a challenging year. FY26-27 should be better. We are expecting 26-27 aggregate to kind of return to the long-term trajectory that India has had. If you look at FY25, the growth will end up being mid-single digits, which is like well below what India normally has on a longer-term basis. But we expect earnings to recover as we go forward. So at this point of time, I would say, yes, we have seen a nice rally of around 10-11% from February. And in dollar terms, the returns are even better. So some of that upside is captured in. And to that extent, moderate upsides and any dips will be an additional chance to add.
So Surinder, in terms of the big moving parts, which is earnings, liquidity, and P multiples, let's get your sense on all these three important moving parts: earnings, liquidity, and then P multiples. Where are markets headed based on that?
So see, on earnings, the point I made is FY25 was a very challenging year. we will end up at mid-single digit. If you look at the current quarter, the way it's shaping up, the trends are broadly mixed, I would say, but within that, two large sectors from earnings perspective, which are delivering better numbers are the large private banks, as well as the oil and gas, the energy companies downstream. So because of that, the reported numbers will look better, but overall trends are quite mixed because on the consumption side, we have seen weakness in select names. As we go forward, I think some of whatever changes have happened in terms of tax slabs, in terms of liquidity, in terms of change in macroprudential norms, all of those things should start helping as we go forward. And we should go back to a more longer term growth in India. If you take a 15-year kind of a number, in any large index in India, earnings have grown at 11-12%. So that's what we expect. That's the view on the earnings side. The second point, which is on the PE multiple, no, Samiran's kind of mentioned that the macro is looking pretty decent. India is looking relatively quite good within the EM construct. I think a lot of things really going in favor at this point of time. And which is why we believe that the PE multiple on the higher side, but it could still be supported. In fact, if you look at our index target, it's at an earnings of around 19-20 times, which is not very different from where we are currently. And then third, liquidity. One of the things we saw, which took the market down around 15% between October, November last year and February, was the FII outflows. And which happened because there was a bit of a cyclical slowdown in growth. Okay, the dollar strengthened, and so all of those things kind of created that. But from a last couple of months, if you look at that's turned positive again, small positive, but positive. Domestic flows have continued to be pretty resilient. And that is what has kind of gradually taken the market up higher. So on all the three factors, I would say things are kind of stable to decent. Okay, and that is what kind of makes us constructive on the market medium term, admitting that the market has bounced back quite nicely. And to that extent, near-term upsides might be limited.
Samiran, if we were having this engaging conversation exactly a month ago, the conversation would have been centered around tariff. Now it appears that there would be a lot of negotiations, some reconciliation, and some logic has resulted when it comes to the tariff interplay. So while talking about macros, are you accounting in the whole tariff which would be at play after that 90-day window gets over? And what kind of assumptions are you making at a global level when tariff windows would be open?
So obviously, this is a very fluid situation where every country is doing their negotiations on the tariff side. And from an India perspective, I think it's a story of absolute versus relative. In an absolute sense, we might, at least whatever the current tariffs are, we might be impacted to some extent, but in a relative sense, India will probably be impacted much less. The second thing is that if India, at least on the manufacturing side, uses the template that we have done with UK, which is that on the manufacturing side, we are offering almost a 0 for 0 tariff, then in turn, it could actually turn out to be better. And the third is that if there is a relative tariff divergence between India and China, then in the initial days, we will benefit from some sort of trade diversification where more and more orders will come to Indian companies. And over the medium term, we can even benefit from supply chain diversification where these companies will be putting up their production hubs in India as well. So these are all the sort of positives that can come out of this tariff scenario in some sense for India. The negative is that we can also get impacted by somewhat cheaper Chinese imports coming in if this tariff differential persists. For our calculation perspective, we had taken about a 30 basis point cut in our GDP growth forecast from 6.6 to 6.3% as a kind of initial take on how things could be. But we also wrote that if for some reason this tariff shock through its secondary effects on global growth slowdown and generic uncertainty around leads to a much deeper growth slowdown below 6%, then India is in a position to activate a lot of additional policy measures not just on the monetary policy side, but also on the fiscal policy side. So for us, the 6% growth is kind of a red line where the policy impetus will become stronger and probably push growth somewhat higher into that 6 to 6.5 type of range.
Samiran, there are two factors which in a sense are still moving parts. One is that the government spending which had slowed down because of election and other compulsions in FY25, when will that normalize and will it normalize? And second is that when will we see the real recovery in the rural part of India, because it's been almost 3 years that we've not seen a meaningful contribution coming from there. Samiran?
Yeah, so we have our own way of estimating the government spending data on a more high frequency basis. And it appears to us that in the month of April, the government has spent a lot of money. Their cash balance at end of March has almost been entirely drawn down in April, which is a sign that this spending has happened. But that's very near term. I think over the more medium term, the big debate is not about the total quantum of government spending, but it's more about the composition of that spending between the revenue spending side versus the capex spending side. Our sense is that the capex spending will still grow at least the nominal GDP growth rate, which is somewhat in excess of maybe 10%. But we are not going to see that 20% plus type of capex that we had seen for a couple of years. That is probably behind us, but more and more we will also have to see this capex to be done by at the state level and at the third tier government level as well. So diversification of capex will become important from the government side, but total expenditure, we think, at least in the near term, has picked up well. The open question is that if for some reason the growth headwinds are stronger, then how does government stimulate the economy on where it can spend more? Those are still very open questions.
Right. Surinder, in terms of, I'll remind our viewers about a conversation which we had a couple of years ago, and you said that look, consumers trade at high P multiple because earnings are predictable. Banks and metals is where you could be in for disappointment and surprise. So what is in store from the obvious sectors, which is defensives and consumers, and what we should expect from slightly volatile sectors like metals and banks?
Sure. So see, what I would have possibly said is that valuations are high for consumer because investors kind of believe or perceive them to be safe and more consistent kind of earning sector. Because for me, consumer staples has been like underweight in our sectoral preference for a long time, for many years now. So it's been underweight or neutral. I don't remember when we had overweight. So in the near term, consumer staples still continues to be slow as far as earnings trajectory is concerned. And it's a sector where we have seen a fair bit of underperformance if you take a 5-year view. And at least at this point of time, we really don't see any signs of recovery. So consumption in general, still a little weak, but staples in particular continue to be very slow growth at this point of time. On large banks, like I mentioned earlier, the earnings are coming out pretty okay. And there, like our belief remains that versus what the aggregate market trends that we see on earnings, the large banks can kind of continue to be a little ahead of that, which given their size, I think is quite commendable. And then again, some of the more volatile sectors, metals, etc., I think they are global sectors, and globally there is still a fair bit of uncertainty and a bit of slowdown as far as developed markets and China are concerned. So there we have underweight positioning at this point of time in our sectoral allocations.
Surinder, the concern in the market is still centered in and around the tariff interplay. While Samiran spoke about it at a macro front, from an earnings front, what should one expect and what should one price in?
First, I would kind of remind again that India, if you look at the earnings, bulk of the earnings for any index in India are domestic, India centered. Okay, there are a few sectors obviously which are export dependent, but at an aggregate level, if you take the weightage in any index, that weightage will come out to be pretty low. And within that, obviously, IT services is a big part of it, which at this point of time, not directly impacted by tariffs, but obviously there could be an impact if there is a further slowdown in global growth. So India, firstly, I would kind of remind that it's more domestic, earnings are more domestic centered. And to that extent, the impact will be lower than what we expect in a lot of other emerging markets. And I think the relative aspect is important here because all the EM money which kind of comes into India, those investors are all looking at it from a relative perspective. Now, if you kind of take it down one level further, I think the sectors where there could be some impact, IT services has been a little slow on growth, but it was kind of expected to be a little slow even before tariffs because globally developed market growth was starting to slow down a bit. And to that extent, growth was looking slow as we went into this year. Among the other sectors, there's not a lot of representation in any major index. So you could have some impact, but again, I think too many moving parts, and I think the impact will also depend on what happens to tariffs in the countries these companies compete against. So, for example, what happens in India on tariffs will also have to be kind of looked at in context of what happens to the other markets on tariffs, because there could be a relative benefit out there, which could also become important. So overall, I would say we expect India's earnings, at least on the tariff aspect to be more resilient than most other parts of emerging markets.
So, Surinder, another follow-up question. Within the domestic space now, there are these lot of storytelling stocks. You like to call them narrative stocks. Some of the narratives were defense, solar. Couple of years ago, it was ESG. What will happen to this entire narrative part in India, the storytelling stocks? And which is the next story you've already started telling your clients? The second part is more important. Samiran, it is a good question. Smile for this question, Samiran. I want to see you smile.
Sure. So first, let me answer. If you look at like our top picks, and obviously I can't talk about single stocks here, but if you look at our top picks over the years, you will typically find an approach which is reasonable growth visibility at valuations which are not very high. And again, I kind of stress on that not very high because there will be times when we are very confident on earnings visibility. And to that extent, the sector might have re-rated and we may still have it overweight in the sector allocation. Typically, we have tried to avoid some of the story stocks, as you call it, where it's not supported by earnings visibility and earnings momentum. So that's how I would look at it. Like if you look at where we are overweight today, it's large private banks, select large NBFCs, telecom, domestic healthcare. Okay, and none of them are really story stocks at this point of time, right? Or story sectors at this point of time. So that's how we look at things. But yeah, there will be times when something really kind of catches the fancy of investors. But I think it really needs to be supported by earnings, and then valuations need to be reasonable in the context of that growth visibility. Otherwise, we are eventually always in for a disappointment.
Samiran, I'll throw in one more ingredient in the melting pot, picking it up from where the Fed chairman left yesterday, Samiran, which is that in the near term, risk of inflation coming back is real. And Samiran, it will happen because the initial data points are indicating that the US labor market is getting tight. The Walmart and other departmental store, the shelves only have space and less products. What are the risks, Samiran, that in the second half we could actually be in for a big uptick on inflation and then the reverse starts, Samiran, which is yields they go up, flows they start reversing and everybody starts talking about inflation coming back?
So let me put it first this way, that our own average inflation forecast for FY26 is 3.8% now, which is 20 basis points lower than the RBI's forecast of 4%. Now, why so? The main issue is that in India, as you know, almost 50% of the basket is food, and that too food which is mostly domestically produced. And this is where we have seen substantial improvement in the high frequency data that we are capturing on the food arrivals, etc., which gives us comfort that at least over the summer months, the kind of vegetable price spike that we had seen in the last couple of years, that is unlikely to happen. On the basis of that, our next inflation print could be even below 3%. So in some sense, we are somewhat different from rest of the world in our headline inflation metric, where while I hear you about the US part, we might not be impacted that way in India. Plus, we have to keep in mind that the way that tariffs are working, it is a negative supply side shock for US, which is inflationary, but it's actually a negative demand side shock for rest of the world, which is deflationary. So in some sense, every other country is going to feel a bit of a deflationary pressure arising out of the tariff. If you ask me, my inflation risk for second half of the year is actually not as much as the direct tariff risk. There are two things that I worry about. One is that what if there is a big supply chain disruption across the world? For some reason, the shipping lanes get clogged because of these tariff related uncertainty. So that's one part. The other part is always very difficult to model, but what if we are stimulating more today compared to what our growth shocks are? This is always a dynamic process and difficult to calibrate. But that sometimes in Indian context, we have seen that whenever we do large rate cuts and liquidity infusion, then inflation comes back very quickly with a small lag. So that these are the two things from inflation side which I will be more closely watching. But for now, our baseline view is a 3.8% average inflation for fiscal year 26.
Such a great point that for US it's inflation, for rest of the world it is deflation. So Surendra, I'll wrap it up with with a reference to Samiran's answer that what if. So for the equity market, what is that what if scenario which could pour cold water on all the assumptions? So what is that what if?
Sure. So I think firstly, like on the three aspects that you mentioned earlier, like if I look at from an earnings perspective, there is a dependence on global growth, right? While earnings may be largely domestic and relatively better than a lot of other EMs. So depending on the global scenario, there could always be an impact on earnings. And if we have the second consecutive year of downward revision, then that could impact the market multiple, which is the second point I was coming to, the PE multiple, which could also get impacted in that scenario. So I think those are the things that one would worry about. And the second aspect I would say is, of course, it's a fairly volatile situation. Things are changing pretty significantly, and to that extent, depending on the outcome of all the tariff negotiations that are going on, if there is a reason why some of the other EM countries start looking more attractive, and you see money rotating back, right? We had a situation very recently in January, February, where you actually saw some of the other EMs benefiting and India really not participating in that. So those are the two things that I would really watch out for, which could change the assumptions as far as earnings are concerned and as far as the market outlook is concerned.
All right, fantastic. Samiran, Surendra, gentlemen, thank you very much for joining us, and certainly hope to see much more of you going forward. Thank you for your inputs and thank you for your valuable time.
Thank you.
Thank you.
All right, let's take a break. It's nothing short of a market. No one's complaining, no one is excited, but you stay here with the kind of noisy environment we are in. I think that is a victory for the bulls. I mean, for me, the mark of resilience was yesterday and even today when markets are not panicking despite what's happening on the geopolitical front. So it's a big departure from what we've seen in terms of the market action and reaction. It's quite decent. The breadth is not bad at all. A little bit of churn here and there, but that's par for course after the recent run-up. Let's take a break.
It's missing